My name is Archana Bhatia. I work as Head of Wealth Management with Financial Decisions. I have Daniel Royley, our Chief Investment Officer, with me today. We are starting a web series to discuss key market trends and their implications on investments. We will be meeting regularly to discuss key market updates. In today's video, we will cover the US reporting season, Chinese tech, and key sectors within Australian share market. Hi, Daniel. Welcome to the series. I would like to discuss few aspects of current market today. First one is regarding US reporting season.
Thanks, Archana, and good to be speaking with you. So the latest US reporting season has been generally very good. I think it's fair to say that the positive trends that were in place going into the reporting season have pretty much accelerated and certainly remain in place through this latest reporting period. And sectors that have done particularly well include the areas like technology, healthcare, and communications. On the more cyclical side of things, we're starting to see green shoots emerging in sectors like industrials and financials. So that's good for the broader market. But I'm just going to drill into a couple of key sectors. Firstly, around technology. So within the technology sector, there's been a number of trends that have accelerated through the last 12 months. This has been in areas that have been related to people working and living more remotely in lockdown situations. So e-commerce, cloud computing, entertainment, those types of areas. And so looking at companies that have really done particularly well in those areas are names like Microsoft and Google, which most people would be fairly familiar with. But to put some of the growth rates that they're experiencing at the moment in perspective, Microsoft grew their sales at 21% in the most recent quarter, and Google grew their sales at 57%. Now, those growth rates are particularly impressive when you consider the fact that these are two of the largest companies on the planet. And so to be able to grow at those very impressive levels at that high base is particularly notable. I think the most important thing for investors going forward is that we think that the trends that we're seeing are likely to persist. So in the case of cloud computing, we estimate that the cloud computing sector has a very long runway of growth ahead of it. And some estimates suggest that cloud computing as a sector is only about 10% penetrated. So companies are going to continue to increase their workloads in the cloud. And so that's going to benefit companies like Microsoft and Google going forward.
It's really interesting to see that technology has advanced probably 10 years faster because of this pandemic. Would you agree with that?
Yeah, there's definitely been a pull forward in demand and an acceleration. Microsoft's CEO last year suggested, I think the statement was they saw 2 years worth of growth in 2 months, or something to that effect. So there's certainly been a big shift there. The big question is how much or how long will that growth persist in the short term, because there has been such an acceleration. Yeah. So there's certainly every chance that in the short term there's a bit of a deceleration in growth, but the key is that we're investing for the long term, and that long-term runway of growth remains very, very good. And so maybe just going to touch on a couple of the other sectors. Firstly, healthcare. So healthcare is a sector that we really like for the long-term demographic trends that are in place, which is basically aging populations in Western economies. And secondly, increasing healthcare expenditure within emerging markets. And so we're investing in Johnson & Johnson, which is the world's largest healthcare company. And that company is very, very high quality. It's globally diversified, and it has operations across a range of different categories. So, for example, consumer products, which most people would be familiar with, medical devices, which is where they have medical implants like hip, knee replacement products, as well as a big eyewear business, so contact lenses and the like. And they've also got a very big pharmaceutical business. So in the most recent quarter, their sales grew by 24%. So again, a very impressive number. But within that result, their medical devices business grew at 57%. And so that business is a beneficiary of hospitalization rates sort of going back to normal, where elective surgery can happen. Whereas 12 months ago with COVID lockdowns taking place, that division suffered. So long term, we think Johnson & Johnson is a fantastic company that we want to invest in, but in the short term, it's also benefiting from that reopening trade. And finally, just on the reporting season over in the US, the industrial sector is really interesting because there's obviously the cyclical driver to industrials, whereby you have the recovery in economic growth and demand coming back online after being disrupted last year. But for industrials, what's really important is the supply chain impacts that are going on at the moment. So one of those is whereby supply chains are moving from just in time to just in case. So there's a fairly large increase in capacity within supply chains to try and avoid the situation that various industries found themselves in last year, whereby there's more capacity in the system. And so that's going to lead to a very significant increase in capital investment. The longer term driver for industrials is really all about automation. So this is whereby industrial companies are looking to drive down the costs of their production and increase their efficiency. So we've looked across the industrial landscape and identified a couple of companies that are beneficiaries. One of those is a company that most people probably haven't heard of. It's called Rockwell Automation. And Rockwell provide systems across different sectors, but basically systems and software solutions to help companies improve their efficiency. And as the name suggests, centered on automation solutions. So that's a company that we think will be quite a big beneficiary of some of those trends.
Well, that's great to hear your thoughts about international markets and different sectors. We have recently rebalanced our model portfolio, and by the sound of it, all of our clients are in your safe hands. So thank you for doing that. I'm just going to change the course a little bit. Chinese technology companies are an area of focus for some of our clients, and in the first few weeks, there has been significant volatility in this sector on the back of increased government regulation. Can you share your perspective and whether you still think there is value in this sector after recent sell-off?
It's a very good question, and it's a space that's evolving week by week and even day by day. What we've done thinking about this question and this part of the market is really considered what are the overarching goals of the Chinese government, and the answer to that is, well, there are several, but the key ones are to promote economic development, which really has a fairly big focus on the technology sectors. And the second thing is to promote social equality. So we think about your question through the lens of what is the broader goal that the Chinese government are trying to achieve, and how do the companies that we're investing in potentially serve those goals. So as you say, in recent weeks, the Chinese government have made a number of announcements that are impacting a number of different sectors. So one of those announcements was around the private education sector, which the Chinese government have announced must now be not-for-profit. And so the rationale behind that is that the Chinese government want to make sure that education is affordable to their citizens. And so by making the sector not for profit, it's going to help achieve that goal.
Right.
The problem for investors, if you're invested in one of the listed education companies, you would have seen your capital decline somewhere of the order of 2/3 in a single day when that announcement was made.
Yeah.
So we haven't invested in any of those stocks ourselves, and certainly won't be in the future. But it does highlight the risks that are out there. I think once that announcement was made, the broader Chinese sector and stocks sold off quite a lot on the basis that there could be potential additional announcements that would affect the value of various Chinese stocks. For us, we have investments in a couple of the biggest Chinese technology companies, so Alibaba and Tencent.
Right.
Both of those companies are extremely high quality. They are providing cutting edge technology and services to both businesses and consumers. And they're going to be beneficiaries of long-term growth trajectories in different sectors, including areas like e-commerce, cloud computing, automation, artificial intelligence, etc. So, and I think the other point to note about those two companies is that they've actually been really, really crucial in the last year or so, helping consumers and businesses functioning in a world that has been affected by COVID with lockdowns. And so I think that's something that we have to keep in the back of our mind. So I guess the big question is, will the Chinese government go after the sectors that Alibaba and Tencent operate in? The answer to that is, in some areas they may. They've already announced different rules that are impacting Tencent. Most recently around the video game sector. They want to make sure that children are not addicted to games. And so they're going to make sure that these companies have various tools in place so that their games are not necessarily in the hands of underage or very young children.
Right.
So there are certainly going to be areas around the edges where it's going to impact these companies. And so I think in the short term, there's probably going to be a lot more noise, more volatility with these companies.
Right.
But from a long-term perspective, those trends certainly remain well in place. It's just a question of how much volatility are you willing to wear in the short term. So we have a very small position in those companies, so that if volatility increases, it doesn't impact portfolios too much.
Right. It's really interesting to see just one little change in government policy, and the stock fell by, I think, 75%. So that's a massive hit. Thank you for that insight. Now let's just look at our Australian market. Australian reporting season is about to get underway in next few weeks. But could you share some of your views on key sectors such as banks and resources?
Yeah, sure. So the Australian reporting season is just about to get underway, as you say. The biggest sectors from the Australian listed market perspective is the banks and resources. So it's crucial to understand and have a view on those two areas. So firstly, on the banks, it's been our view for the last 9 months that the banks are amongst the best places to put capital on the basis that the domestic economy would be coming out of its lockdown stupor as a result of the very low COVID rates that we had end of last year. and also that's supported by the very favourable policy settings that are in place from both governments and central banks all around the world, which is low interest rates and fiscal stimulus measures. So, we've been pretty positive on the banks. Looking forward, the outlook's a little less clear given the Delta variant that's really exploded on the East Coast, particularly in New South Wales, which has resulted in lockdowns re-emerging. The good news as far as the banks go is that their balance sheets are in excellent shape. The favourable policy settings that are supporting the economy still remain in place. The central bank is still keeping rates basically at zero until 2024 and purchasing bonds in the market. And so those measures should ensure that the banks and their loans are well supported. The housing market remains very strong, and so you put all those things together, and the banks look like a pretty reasonable place to have capital allocated to. And as far as the banks' confidence go, they're in a position now where they're actually buying back stock. So ANZ and NAB have both announced buybacks. Collectively, that's $4 billion worth of buybacks. So they're obviously confident in the outlook. Otherwise, they wouldn't be buying back $4 billion worth of their own stock. So for us, the banks look okay, and the dividend yields look pretty attractive as well. In the case of resources, it's really all about the global economic growth backdrop, which has been very, very good in the short term. And in the going forward, commodity prices will probably moderate somewhat, particularly iron ore, which has recently hit $200 a tonne. It's now trading at about $160 a tonne.
Right.
Long term, iron ore should be trading under $100 a tonne. So, and the reason that it's at such an elevated price point is that we've had supply disruptions out of Brazil. And we've had, so that's on the supply side, and on the demand side, we've had a lot of Chinese stimulus for steel production and therefore iron ore demand. And so the likes of BHP and Rio have been major beneficiaries of iron ore prices where they are.
Right.
And those companies, pleasingly, this cycle have not wasted capital. They've actually preserved capital. They haven't ramped up production like they have in the past, which would have seen more production online and therefore lower prices. So they've been very, very disciplined in that sense, and I think that's going to help them going forward as far as and their shareholders. So both of those stocks are expected to produce dividend yields between 6 and 7% per annum over the next few years. And that's even in an environment where iron ore prices come down towards those sort of longer term prices. So it's certainly not our expectation that iron ore is going to stay where it is in terms of price. But even when you assume that prices do come off, the dividend yields and cash flows remain very, very good in those names.
That's really comforting news, given the current environment. I think if Australian companies can maintain their dividends, that would be a great thing for our clients. Thanks, Daniel. There is certainly no shortage of information to digest, and it has important implications for our clients and their portfolios. We'll carry on producing these series. So thank you very much for the start of this series. And it's great to hear your point of views, and I'm sure our clients will be very comforted by hearing what you're looking at and how you're making your decisions. And for clients, if you would like to hear a little bit more about how we're constructing our portfolios and how it's going to impact you, please contact your advisor, and your advisor will be able to answer your questions, or they will contact Daniel and they will bring him in the meeting. So thank you very much. Appreciate your time. Thanks, Daniel.
No worries. Thank you.